Across the strategy, we see profound and enduring secular tailwinds supporting the underlying financial results of the companies we invest in. These are perhaps most prominent amongst our electric utilities, who have a long runway of growth, likely to last at least a generation, supported by the energy transition as these companies invest to replace their legacy thermal generation with renewable assets, as they augment their distribution and transmission networks to connect new renewables, and to support the electrification of buildings, transportation and industry. And more recently, as we've seen the re-emergence of load growth supported by rapidly growing demand for data centers and the re-industrialisation of the US economy. So particularly robust outlook and growth expectations there. But those drivers are really replicated across the strategy. Amongst our water utilities, we see profound growth driven by increasingly stringent environmental requirements and the need to secure supply resilience. In our toll roads, they're leveraged to the increased economic activity and growth in their catchment areas and benefit from inflation-linked revenue growth. For our airport companies, we see continued growth at a multiple of global GDP, supported by the increasing affluence of the middle class in the emerging world, for instance, and by the continued decline in the cost of air travel in real terms that, while it was briefly disrupted by the pandemic, we expect to continue in the long term. And finally, for our communication assets, where we expect significant growth in demand for mobile data, Ericsson puts it at perhaps 20% per annum over the period to 2029, to continue to require mobile network operators to hang more equipment, to deploy more towers, to increase the quality of their service that they provide to their customers. And of course, all of that lends itself to the tower companies growing adjusted funds from operations and earnings in a manner that's very accretive to shareholder returns.